Thanks for clicking. Canada's mortgage rates are down this month as bond yields fell midway through the month, with investors hoping the Bank of Canada would be reversing rates in the short to midterm future.
You're going to be very disappointed.
While bond yields, the amount of money that can be made off a Government of Canada bond, have risen since the release of Canada's inflation rate last week, fixed mortgage rates are still down from June and July. But what about variable rates? The Bank of Canada is set to raise interest rates next month by a minimum of 50 basis points, with many predicting it will be more like 75 basis points, which will make variable rate mortgages even more expensive, leading some to wonder whether or not fixed rate mortgages are the best option. So what I want to do today is go over the best fixed rates compared with last month, see how they compare with variable rates, especially in light of the upcoming rate hikes, and then take a look at some things to think about when choosing variable or fixed rate mortgages. As we'll see in a few minutes, these interest rate hikes are expected to continue for some time, which will continue to put downward pressure on Canada's real estate market. We'll continue to have updates out on those rate hikes on this channel. Click like and subscribe to get those updates, but for now, let's get into these mortgage rates. First off, the best insured mortgage rate. If you'll remember, an insured mortgage rate is where you have less than 20% down, have a 25-year amortization, qualify at 5.25 or the contract rate plus 2%, and you pay the mortgage insurance. The best insured mortgage rate was down this month from the previous 2 months, with June having a 4.99 interest rate, July having a 4.64 interest rate, and the best 5-year insured rate this month was 4.44. or 0.2% higher than it was last month. And this was also echoed in the best 5-year insurable mortgage rate. An insurable mortgage rate, if you'll remember, is where you have 20% down, qualify at a 25-year amortization, and you don't pay the mortgage insurance. Insurable rates are also down. If you'll remember, in June, the best insurable rate was 5.39, which shrunk down to 4.99 in July, and as of this video are down to 4.79. So insured rates and insurable rates both down 0.2% or 20 basis points from this point in time last month. But the same cannot be said for uninsurable mortgage rates. An uninsurable mortgage rate, that is where you have a 30-year amortization, or you take money out of your house via a refinance, an equity takeout, etc. If you'll remember, in June, the best uninsurable rate was 5.39, which shrunk down to 5.24 in July, and that rate has stayed the same this month at 5.24. So, while purchases on 25 years, either insured or insurable, are both down 0.2%, if you want to take money out of your house or you want to have a 30-year amortization, then the rate has remained unchanged. But what about variable rates? Right now, the best 5-year variable rate mortgage is prime minus 1.05. With prime being 4.7, that gives the borrower a rate of 3.65 right now. So 3.65 right now on a variable mortgage rate compared to 4.44 on a fixed rate. But what does this do to mortgage payments? Just as an example, let's take a look at July's average house price of $629,971. If we take that $630K house price and we use a 25-year amortization at a 4.44% interest rate, we get a monthly mortgage payment of $3,401. That same scenario, using a variable interest rate at prime minus 1.05 or 3.65%, gives us a mortgage payment of $3,131. So right now, the average buyer saves about $270 per month by going with a variable rate mortgage. However, if the Bank of Canada raises rates by 50 basis points next month, that brings that mortgage rate up to 4.15, which bumps that mortgage payment up to $3,300, or $100 less than the current fixed rate. And if the Bank of Canada bumps rates up by 75 basis points, that payment goes up to $3,387, or about $14 less than the current fixed rate.
That escalated quickly.
As we just saw, the financial advantages of a variable rate mortgage can evaporate very quickly in an environment of rising interest rates. As of right now, if you choose a variable rate mortgage over that of a fixed rate, you really are betting that the Bank of Canada will be reversing its course on mortgage rates in the short to mid-term future in order to realize the gains of that variable rate mortgage. And the bet that the Bank of Canada will reverse course is almost impossible to quantify, as nobody has any idea where interest rates or the inflation rate will be in 1 year's time, let alone 2, 3, 4 years' time. When Canada's real estate market hit its peak in February of this year, the average house price was $816,720. At that time, a decent variable rate was prime minus 0.75 or 1.7. Buying that average house price in February of this year would have entailed a mortgage payment of $3,236. However, with prime having risen from 2.45 to 4.7, that payment has now gone up to $4,150. So that's nearly a $1,000 difference in mortgage payments in just over 6 months. So you have to ask yourself if you can afford those mortgage payments if rates continue to go up. If rates continue to go up another 1 or 2 or even 3% over the next year, 2, 3 years. You really have to ask yourself if you can take the swings in mortgage payments. As we said, nobody knows for sure where interest rates will be in a year's time. At this point in time last year, our inflation rate was at 3.7%, which everybody thought was sky high, and the Bank of Canada said it would be temporary. 1 year later, I'm sure Bank of Canada Governor Tiff Macklem would give his right arm for a 3.7% inflation rate. So, things can change very quickly, and you want to make sure that your budget can handle the swings if they do. With that said, we will continue to track those swings and those changes in the mortgage rates and the Bank of Canada's interest rate policy on this channel. If you want to get those updates, make sure you click like and subscribe. But for now, thanks so much for watching.